Yo, what's going on, everyone? Welcome back to another video. In today's video, I'm going to be going over the two types of setups that the market always presents. It's either one or the other, and how you could use these two setups to catch amazing trade opportunities and potentially make profit. Now, before we get into this, I want to go over this Instagram post that I made on the 5th of the 9th of May. And it was basically a USDJPY price prediction that I made way before it happened. You can see the date and everything and when I posted it. So as you can see, May 9th. So what I was expecting was the market broke structure. And from there, what I was expecting is one of these two zones were going to act as a level of supply for the market to later crash. And remind you, this is way before the market actually crashed. So I was basically anticipating a major crash from either one of these two levels. And this was the theoretical example of why I'm looking to anticipate this. And yeah, now let's go to USDJPY and see what happened. Now, actually, let's take a step back. Before we get into what happened, let's talk about the first market fractal setup. So the first setup is called the one-sided market. Now, the one-sided market, what is it? The one-sided market, it's when the market is trending one specific way, whilst it only gives you one opportunity per trend. So what is a trend? One trend consists of a low or a high, a low, a lower high, and a lower low. This is considered as one successful trend. And within this trend, if you're trading it based off of the higher time frame and you're trying to follow the supply, you're trying to follow the market, you will only be presented with one opportunity, and that opportunity is going to be the pullback. Now, the reason I call this the one-sided market is because it's following one side. It's choosing one side, which in this case is supply, and it's following that supply until it reaches a level of demand. So in this example, we could see that. So let's pretend like this picture right here started off from this point. You know, we had a bunch of bullish price action and structure was broken right here. So now that we know structure was broken, as soon as structure is broken, we can see that supply starts to kick in compared to the demand. And once supply starts kicking in, we have these pullbacks in which the market comes back towards the last impulsive move down that broke structure. And within that last impulsive move down, there resides a supply zone. Now, whether you set a limit or wait for confirmation, that's totally up to you. But the whole concept that I'm teaching in this one-sided market example is that the market will only come towards those last impulsive moves of supply. So, for example, when you have this impulsive move right over here, and they have an impulsive move right over here, there's going to be two impulsive moves in one leg. The pullback phase of the higher of where the lower high is being created, that's where the market will find the institutional candle, such as the supply zone, and use that supply to continue its trend. So now that we have our the first leg complete, like this whole thing is one a successful market structure, we can move on to the second one. Now the second one, when the market makes its pullback, it will either come towards the top, or it will find the mediator, which is just going to be the medium, the median, the equal level, which is the 50%, and then the market will continue to sell off from there. Now we can see in this example, this is exactly what happened. You have a level of supply. It's better if I use this. So we have a level of supply in which price action comes to lastly mitigate. After we mitigate it, we do the same thing. We end up selling off one more time, creating this impulsive move right over here, which later takes out this previous lower low, and the market does what? It comes all the way back up to retest this institutional candle, which resided at the medium level, the 50% in the middle, or you could call whatever you want, the equilibrium, in which the equilibrium institutional candle resided. The market came inside of it and then later sold off more. Now, this is called the one-sided market, and the same rules apply to the demand zone. So if price is in an uptrend and demand is being followed rather than supply, you would follow the same rules. So what are the rules? Well, the rules are, when you're trading the one-sided market, you basically just want to follow the demand and supply. So what's happening in this one-sided market is the market is going to so let's assume we're going to use a bullish example right here. The market is going up to reach a higher level of institutional candle, a higher level of point of interest, whatever you want to call it. So the market is basically going up and it's trying to get there as fast as it can, so the market can later go down. Now, the reason this happens is because basically, although the smaller time frame, you could call this the internal trend may be bullish, right? The short term may be bullish right now, but institutions have they have higher interest in selling the market off. But remember, what do institutions do? How do they sell and how do they buy? Well, they buy when things are cheap and they sell when things are expensive. When things are way too expensive to buy, what happens? The market starts selling off. And when things are way too cheap to sell, the market starts going up. This is when we buy. Now, in this case, when the market reaches, we're going to be using this example right here. The market must have reached a level where it was way too expensive to buy now, right? It was way too expensive to buy and price was just too high to sell. So what the market makers do is they reverse price. They say, okay, let's reverse the market down now because we have intentions to buy, but we can't buy right now. We can't buy because things are way too high. It's too expensive. Just as a if you go to the mall, if you go to try to buy a computer or some clothes, if it's too expensive, you're probably going to wait till Black Friday or one of these discounted weeks. And once the discounted week comes, that's when you're going to buy. So the market maker has a similar thought process. When things are way too expensive to buy now, what they do is they reverse it. They start selling off. And then when price is low enough to buy, that's when they will buy. And what you're going to notice is when we are selling off to buy, because this is basically a sell so we can buy later on, the sell is going to move really, really quickly. It's not going to go up, down, up, down. It's going to move really quickly. We're going to have a big move down and then a mini move up, a big move down, a mini move up. So this is called the one-sided market. And the reason we have these really quick moves, let me delete this because this is starting to look something inappropriate. But yeah, so when the market is moving really quickly in one direction, it's doing that because it needs to get to its objective really quickly. So now let's move on to USDJPY. As you guys saw, this was the anticipation right here on the May of 9th, January, February, March, April. Yeah, so the 9th of May, 2022, I was anticipating this crash. Now let's move on to what ended up happening. Let's go right over here. So let's go to the 1 hour time frame. Oh, actually, have to go a little bit farther back. It was right over here. Perfect. So this is the start of the one-sided market. Now, how can we identify the one-sided market? So the best way to identify the one-sided market is to understand when to use microstructure and when to use macrostructure. So what is micro? What is macro? So a perfect example of micro and macro is what I'm staring at right now. So the 4 hour time frame, we could see from a zoomed out perspective, the trend is obviously moving towards the upside. And these red circles that I'm labeling, these are called swing point lows and swing point highs. The reason we call them swing is because the market had major reactions after we created that level. So right after we reached this top, the market sold off, and right after we created this bottom, the market bought up. And once again, right after we created this top, the market sold off again, and once we created this bottom, the market bought up again. So these are called swing points, and a swing point is extremely important in a trend. The reason it's really important is because the swing point represents where the last major buying pressure started and where the last major selling pressure started. So right here we can see that this is where the last major buy was placed. We can assume that this is where the last major buy was placed because of the reaction it had. And right before that buy happened, sellers were in control. This is where the last sell took place. But right after that sell was over, we saw that the buying pressure started right here. So now we can assume that a major buyer, a big player in the market was looking to buy at this level. Now, right over here, we created the top, right? Now, we know that this is the macro trend. The macro trend means that in order for me to be bearish, we need to break past this low. That's the macro trend. So if we zoom down to the micro now, what is the micro? The micro is the structure that's created inside of the macro leg. So this is the macro leg. A leg is basically just one move up that creates a higher high. So notice how on the 4 hour time frame, we weren't looking at the mini structure that resided inside of this. It was just this point to this point because it was a swing. But if I go down to the 1 hour time frame now, I can now see that there's microstructure. So microstructure is the structure that resides within the macro leg. So you have a low right here, and then you have a high, a higher low, a higher high, a higher low, and then a higher high. Now, what do these micro lower lows and or micro higher lows and higher highs represent? Why is it important? Well, the reason it's important is because if the micro level is being respected, let's assume that this is the micro trend and price is failing to break below the micro levels. What that basically means is that buying pressure is super strong and there's no intention to sell, and that we're going to continue to follow this range. But if something like this happens where we break past a micro level, remember this is just the micro level, not the macro. So if something like this happens where we break past this micro level, what this represents is that the market may be heading to the next range, right? So for example, right here, we broke past this micro low. That means that we've just opened the possibility of the market to heading lower. And where will it head lower? Well, that depends on where the institutional candles reside. Because if we go to the 4-hour time frame, although microstructure is broken, we know that in order for price to be like definitely bearish, we have to break past this low. Now, that means that the market can do whatever it wants between this low up until this high. But what allows the market to actually go down? What's allowing price action to go down lower within this leg? Well, it's the fact that microstructure is being broken. If we continue to follow, or not we, but if the market maker continues to respect microstructure, this move down will never happen. We will never see the market go down towards this low, this low, this low. All that's going to happen is we're just going to continue to go up. But because microstructure is broken, we can now assume that selling pressure for the time being is active and it's more important than buying pressure. So for example, this move down right here, we could see that this move down highlighted right over here was a strong level or a strong area where sellers took over. Now, not only did sellers take over, but we broke microstructure. So if we broke microstructure, that means that we've opened the range, or not we, but the market makers, the people that are selling, they've opened the range for price action to falling from this low or from this high all the way down to this low. So now the market is open to do whatever it wants between this range, but it cannot break this range. If we break it, we're no longer bullish. We're going to be bearish. So this is why I was anticipating the market to sell off now, because I saw this impulsive move down. And that represented that microstructure is no longer maintained, and that the microstructure, the micro bullish structure, is going to be changed to micro bearish structure. Now, where is the market going to sell off to? Well, that depends on where the institutional candles reside. And this is actually a perfect example of the second trade opportunity that I'm going to be going over, but we'll do that in the next example whenever I'm done finish explaining the first one. So in this case, we can see that there's an institutional candle residing right here. You could also refine this down to the 3-hour time frame. And this basically means that the market will be bearish until it reaches this area of demand. There we go, clean. So that means that now that there's a micro BOS, microstructure will be bearish until we reach this area of demand. Now, if I go back to the 1-hour time frame, what is my next step? Because we've established the first thing. The first thing was that structure is now bearish. And if structure is bearish, we can move on to the second thing. Now, the second step is finding your impulsive move. And the third step is locating your institutional candle. So right here, we can see that all we did was look for the impulsive move that caused the BOS. Now, sometimes this can get a little bit tricky, because if we zoom down to the smaller time frame, we can now represent two impulsive moves rather than one. We have one impulsive move right over here, and then we have a second impulsive move right over here, right? Because this is where the pullback phase started. Let me quickly move this. So now, what's a good way to avoid making the same mistake? A good way to avoid making this mistake is not to overextend or overuse the smaller time frame. Rather, use the higher time frame, stick to that, and use one big impulsive move down rather than two. So on the 4-hour, we can see that the impulsive move down would have just been this one big move down. Now from here, I went down to the 1H because now my final step is to locate the institutional candle. So to locate the IC, I simply went to the 1-hour time frame and I found two levels of interest. As I said before, you're gonna find the institutional candles either at the top of the impulsive move, and if you watch my last video, you would see that I used this Fibonacci to measure the discounted and premium levels. But yeah, so if you take your Fibonacci out and you measure the top of the move all the way to the bottom, what you're basically doing is you're labeling the prices. You're basically labeling where the market is most likely to go to and where the market is most likely not to go to. So we could see that in the 0.886, 0.70 0.86 and 0.02, they're blue levels, and blue levels basically signify that things are more expensive to sell. So if price is really high, that's when the banks are going to sell. That's basically the concept of Fibonacci. It's not that you want to randomly sell at the 0.50 and the 618. That's something that we're taught as retailers, and it doesn't really make sense. But yeah, so the higher the price, the better. In this case, we found institutional candles at the 0.8, or basically in the blue zone, and then we also had one more in the 50, 618, and 38.2 level. Now, if you have an IC in the 50, 38.2, and 618 level, it's not that it's invalid. I used to take the opinion that it's now invalid and you wouldn't want to sell there or buy there. I'm slowly changing my mind. The reason I'm changing my mind is because I've noticed price action uses institutional candles that aren't at the discounted or premium level. Sometimes they're just in the middle, and that's totally fine. With these institutional candles, you just want to apply more confirmation to them. Because they are weaker compared to the one that's above, that doesn't necessarily mean the market isn't going to use it. All it means is that there's maybe 70% chance of this one holding and a 90% chance of this one holding. But that doesn't mean you're going to completely ignore that it's 70% possible just because the 30% is missing. So in this case, what you want to do is you want to wait for confirmation, and that's what I did right over here. So I wrote confirmation, because as you guys all know, I will never take a trade just based off of one mitigation. There has to be two. So this is the first mitigation right over here. After the first mitigation, I would drop down to the micro time frame, and then I would go down, look for my range, my next impulsive move, and enter based off of the second mitigation and enter there. Now, the benefits of doing this is that you're increasing your reward and minimizing your risk. So your risk went from a possible like 15 pip stop loss, and remember, pips don't matter, but the thing is, the bigger the stop loss is, the less leeway you have in using a higher lot size. Now, if I have a 15 pip lot size or 15 pip stop loss, that means that I'm going to have to lower my lot size for 15 pips to equal 1%, because at the end of the day, we only want to risk about 1% or lower. But if I have a 2 to 3 pip stop loss, I can now risk 1% and use a way bigger lot size, which will give me a bigger reward, and my risk will maintain 1%. And that's basically called compounding your interest, because it allows your account to grow while you're maintaining the same level of risk. Now, back to this. So what ended up happening is we waited for price to come in, and something important happens. Now, what happened right before we entered is called inducement. So what inducement is, it's basically the market approaching your point of interest, whether it's a supply zone or a demand zone. It approaches your point of interest and it misses it just by a pip or two. Now, when we put ourselves in the shoes of a retailer or even a trader who trades the same way as us, right? But yet his psychology isn't the best. When he sees this, what he's going to assume is, oh, wait, what if the market was using this supply zone instead? What if I over-refined it? And what's going to happen is you're going to start changing and accommodating your analysis for your emotions, because you're afraid that you missed the move. But if we go back to the 1 hour time frame, we know that our 1 hour IC hasn't been mitigated yet, and all we have to do is wait. So what's happening is the banks are inducing you to take trades early, way before price action enters your point of interest. So now let's use smart money concepts. We're going to use the smart money concepts, but we're going to use it based off of this trade right here, this impulsive move. So what a lot of traders will do, is they'll start changing their analysis. They'll start changing their analysis to accommodate for their emotions. And this is the biggest mistake you can make. Now, we can see that price hasn't entered our point of interest right now. And if the market hasn't entered your point of interest, I'm usually not even at the charts. I don't even look at it. I usually just set an alert, like right over here. I'll click this line and then I'll set an alert. And once the alert is activated, that's when I'll start monitoring price action. But if we're staring at the charts waiting for the market to come into our level, but then you see something like this where the inducement happens, where the banks merely like miss your limit by like a pip or two, and then it goes down your way, this is called inducement. They're basically inducing you. They're testing your emotion to see if you're going to enter early. And if you enter early, what happens? Well, we know that the market has to come up to mitigate this 1 hour IC. That means that even if this point of interest holds for the time being, eventually it's going to get broken, so we can mitigate our point of interest right here. That means that when you're entering early, you're actually putting your stop loss in our point of interest. And that is one of the biggest reasons why the market moves in such a volatile way after entering a POI. So in this case, if we were an undisciplined trader, and I already know what's going to happen, so I'm not going to act surprised or anything, but if we were undisciplined and we decided to change our trading plan, change our analysis because of our emotions, then what we would have done is we would have seen this impulsive move. I would have seen that the market missed my limit by a pip. And instead of understanding that the 1 hour IC is completely fine and it hasn't been mitigated yet, I would go down to like the 15-minute or the 5-minute, and I would move my institutional candle to here. And I'd be thinking, okay, yeah, now the market has mitigated it, and now I can enter here, and structure shifted as well. So that's perfect. So let's play this out. Let's say you get triggered. I'm not sure if that triggered you in, but so let's set our take profit at the bottom right here, because that's initially where we're going to target anyways. So okay, now we get triggered, and let's see what ends up happening. So it goes your way for a while, okay, goes down. Okay, here we are. So see that the market goes your way for a while, and this is the power of inducement. Let me go back to the 1 hour time frame actually, and we can move our point of interest back. So this is called inducement, a perfect example of inducement. So what happened is the market tested this level, this impulsive move going down that broke structure, and it gave you a good amount of, it gave you a good move down. Regardless of whether or not it was right, it gave you a decent move down. And if you targeted this low, this would have been a really good trade. But I'm not here to deny the fact that this is a good trade. I'm here to say that if your trading plan tells you to wait for price to enter your point of interest, then remind yourself to wait, because you can't catch every single move down. It's either you catch 1, 2, 3, 4 at the max. If you catch 4 moves, you're lucky. But in trading, all you really need is one trade a week. One trade a week, and that's it. You could call it a day. So when you're trying to catch every single trade because you're worried about missing out on the move, you're basically putting your account at risk, because you're not following your trading plan, you're not following your analysis. And this is a perfect representation of that. You can see that price comes into this point of interest, it goes down, but if you're targeting the demand zone, the higher time frame one, what would have happened is you'd get extremely happy that the market is going down your way. This would have been a 8-to-1. You're like, yo, we're super close, maybe just 29 pips away. In the next hour or so it'll hit it. Now what happened is you were induced by the market coming near your point of interest but not mitigating it. So you're induced, in which you set an entry. Now after that entry, what did you do next? Not only did you, but retailers started to get involved. We could see that there's a level of resistance, and then we could also see that there is a level of support. Sorry, you can ignore that. So we can also see that there's a level of support. Now all these traders are getting induced, and where are they setting their stop losses? They're setting their stop losses right above, inside of my POI. That means that the market is more vulnerable into entering this point of interest. And when it picks up all that money, right? It's payday. Boom. Say goodbye. The market is literally tanking down. It's putting its pants down and just straight up tanking down. So what happens next? Well, the market goes down and then it reverses. Now, let's stick to the institutional concept rather than retailers, because we know what retailers are doing. But what about institutions? Well, us as an institution, as the people that try to mimic institutions. So what they would have done is they would have set a second limit right here, because look, there is another impulsive move going down and it breaks structure or continues structure. Therefore, you'd be thinking that, yeah, the market is just going to follow the supply and go down. Now, the biggest mistake was we didn't enter the 1 hour POI. So all of this could have been avoided if you simply just waited for the 1 hour POI. Now, if you set a take profit here, I'm not here to deny that this would have been a perfect trade. All I'm saying is follow the rules. But what ended up happening is we have this big spike, big spike. And ask me why. Why did we have this big spike? Well, the reason we had this big spike is because of all the liquidity that was traded within from this low to this high. All the money. So there's retailers, smart money traders, break and retest traders, support and resistance traders, and all their money is basically scattered around. It's literally everywhere in this trading range. And that's why the market moved up so quickly, entered our point of interest, stopped out every single smart money trader selling from here. And then what did it do next? It fully sold off, and the real impulsive move down happened. Now let's compare this. Let's compare this impulsive move down to the inducement impulsive move down, and it's going to be really, really different. You'll notice the difference almost like automatically. So the big difference is this move down was literally small. It was nothing too interesting. There wasn't a lot of volatility. Let's draw it like this. There wasn't a lot of volatility. But after, and this is, remember, this is way before price entered our point of interest. This is when it came near to it but didn't quite enter it. But after we entered our point of interest, look at the volatility and volume inside of this impulsive move down. We could see the difference almost immediately. It's like night and day. Not only that, but there's also another micro break of structure, right? So we have a break of structure. So now we know for a fact that yes, indeed, in fact, that this point of interest is activated, and now we can look for confirmation on the smaller time frame. Now I'm not gonna get too deep into the confirmation side of things. We'll do that for another video. But now I'm gonna go over how you could have followed the supply, what you could have done to follow the supply all the way down. So let's play this out. Now, what happens here? What happened here is the market broke past this macro low. And as I said before, if we break past the macro low, that means that the market is now in the bearish trend. But it's only going to be in that bearish trend until it reaches the next level of demand. And in that case, that would be right over here. And I refine this down to the 2-hour time frame right here. It's 2-hour point of interest. Clean. Okay, so let's go back to the daily. So structure is now bearish. Even though price action has entered a demand zone, that doesn't mean structure is now bullish. Structure is still bearish because look, we created this low, we created this high, we created this low, and then we created this high. And yes, this low did close up, this high closed above the previous high. So now that macro structure was broken, it doesn't matter what demand zone it enters. It doesn't matter. Structure is bearish, and you need to treat the structure as if it's a sell side market, because it is. Now, that doesn't mean it doesn't matter when price enters the demand. It does matter, but we have to be patient and wait to see what the reaction is like. So if the market somehow enters this and then it goes all the way up, then of course we'll change our bias. But for the time being, if the market is showing bearish structure on the 4-hour, the 3-hour, the 2-hour, the 12-hour, then we have to treat it as a bearish market. But we will be bearish up until we reach a demand zone, and that demand zone could either be here or it could be way more down, somewhere further. Now, how do you actually follow the supply in the example that I showed you right over here? Well, in this example, let's go to the 4-hour time frame. We can see that there was a supply zone here and a supply zone here. Now, the first supply zone was mitigated, so we have our impulsive move down, the retracement, and then the second impulsive move down. Now, in the second impulsive move down, which is right over here, where are the unmitigated candles? The only unmitigated candle that I can see is one that resides right over here. This is the only I see, and this is the last institutional area of supply that the market created way before it sold off, breaking past its macro low. So in this case, we would want to set limits at this point of interest right here. And I did not catch this, by the way. This is all hindsight, so I'm not taking any credit, but I'm simply just showing you how you could have caught this if you use this concept correctly. To make this 30, and yeah, so limits would have been right here. And remember, limits are valid because we already have one mitigation here, and this would have been the second mitigation. So right now you would have gotten triggered, and what ends up happening is the market is going down. Now, price action enters this demand zone. By the way, it went down really nicely. We can all see that. If you caught that move, then I'm really proud of you. Good stuff. Now, price action entered the demand zone. What do we do now? Well, just because we entered the demand zone, that doesn't mean structure is going to be bullish all of a sudden. We still have to prioritize the macro structure over the micro. So the macro structure is going to be from this low where the structure, where the crash started. And then we're just going to do the same thing. The crash started here. The macro low was printed here. The next crash started here, and the next macro low was printed here. So in order for me to be bullish again, we need to break above this high. All right, so now that we broke past this low and this low, how am I going to continue to follow the one-sided market? Well, to follow the one-sided market, do the same thing. Find your institutional candles that are unmitigated. One here and one over here. And then because there hasn't been two mitigations, that means we'd have to wait for confirmation here and over here. You wouldn't set limits. But these levels is where USDJPY would continue to sell off. Now let's play this out. I think USDJPY is being a little bit unsubordinate right now, a juvenile delinquent. Okay, so it looks like price did not make its way all the way back up towards this POI. That doesn't mean it's not going to be respected later on. Now, this is a good example. So although this POI wasn't respected, price came near it and then sold off, that doesn't mean it's not valid anymore. It's still valid. The market will approach it sometime near in the future, but we have to follow the supply. So in this case, we have another impulsive move going down here. In that case, you would find the next supply zone and wait for confirmation there. And once that supply zone is, touched, you wait for confirmation, catch the trade. Oh, my fault. Once price action enters that level, you want to wait for confirmation. And if the trade gives you confirmation, then you'll catch the trade. And if not, no. And we could see that right now, this is exactly what's happening. Price entered this point of interest, which is I'm actually looking on the smaller time frame for confirmation inside of the mentorship. I let everyone know that we're looking for confirmation right now. So, we'll see what happens next. But these two levels that I'm so focused on, they're still valid. And mind you, structure was also created. New structure was also created. So let's delete all of this. Let's delete everything here and let's reanalyze the macro view. The macro view is this high to this low. And then from this low, from this high to this low, from this low to this, from this high to this low, and then from this high to this low. Now, if the market does something like this, where it does not respect this supply zone and we break above it, that means that the one-sided market is no longer a one-sided market. And what has happened is a structure was broken. Structure was broken. So the supply zone that I'm waiting for right over here, that doesn't mean it's not valid. It's still valid because remember, if structure is broken, that means that we're expecting the market to come back to reverse. And it needs another level of supply to hold price down before it can go back up, right? So in this case, if the one-sided market is finished, right? We break past this level, price action enters the supply, and then it goes down. We're basically anticipating the market to break it a second time. So the second time it approaches it, it will break because there is a break of structure. But if the market continues to follow the one-sided market, then what's going to happen is we'll just continue to hold this level of supply that price is in right now, and it'll continue to sell off until the next point. Now, one final example, I'm going to show a theoretical example. Or we can actually go to GBP/JPY for the example because I was trading this last week. And there's a really, really clean example on GJ. So let's go down to the 5-minute time frame. Now on the 5-minute time frame, we could see that microstructure had shifted from bearish, right? We were extremely bearish to bullish. We have this change of structure or break of structure, whichever you would like to call it. From that change of structure, break of structure, whatever, you can see price comes back down and respects this area of demand. Now, as we know, what is a one-sided market? Well, the one-sided market, all it is just a way for the market to reach a level of supply so that it can reverse long-term, go back down to where it wants to go. So price action creates this demand zone, comes inside of it, goes up. Right now that we have this new impulsive move up, where's the market going to go next? Well, we're going to find, once again, an institutional candle that resides either at the bottom or the top. In this case, we have an institutional candle right here. The market comes inside of it to mitigate it, and then we go back up and continue structure. So the fact that the structure was continued, it basically confirms that the one-sided market is still in control. And then what happens again? The market creates an impulsive move. It comes back down to this final last impulsive move that created this institutional candle. And then the market moves away from it. What happens next? You have another impulsive move going up. Price breaks above this previous high, comes back down into this final area of institutional candle, and then reverses. And it continues to follow this one-sided market, this one-sided level of demand until it reaches a higher time frame supply. And this higher time frame supply is right over here, a perfect example. So once we enter that higher time frame level of supply or demand, depending on what situation it is, in this case, we have a 1-hour level. The market reversed, and what happened? All the one-sided level, all the one-sided demand turned into liquidity. So once we enter the higher time frame level of supply, the one-sided market is no longer valid, and every other demand zone is no longer valid. You want to change your structure. You want to change your mind into selling rather than buying based off of structure, the story of structure. So that's one. Now we'll go over the second one. Now the second one is called the swing entry. Now this is one that I love to trade. This is probably one of the most easiest setups to trade, but it requires a lot of patience, and I'm not gonna lie, Took me a while to learn how to be patient. But once you get that patience and you actually know how to trade it properly, it's probably one of the best ways to trade. So what am I talking about? What is called the swing entry? So the swing entry, what it is, it's basically when you just trade based off of the 4 hour, the 1 daily, and basically anything within the 1 daily to 4 hours. So the range is from the daily to the 4 hour. I'll just write 4 to the 4 hour. Add a nice smiley face right here. All right, there we go. All right, so the daily to the 4 hour. So that means that you could use the 12 hour, the 8 hour, the 7 hour, the 6 hour, the 5 hour. But for the people that don't have TradingView Premium, it's okay. The daily and 4 hour is just as good, and you could even use the weekly. There's no limit. Now, what you do for the swing entry is basically you trade based off of macro structure. So in this case, we can see that there is a so there's a macro low right here, and there's a macro high, and then we have another macro low, and then you have another macro high. Once again, you have another macro low, and then do we have another macro high? No, we don't. Right here is the last macro high. So the swing entry is basically when you're trading based off of the daily and the 4 hour, and after every single time there is a level that's broken, so there's a continuation of structure, you literally wait for the market to come all the way back down to the original expansion move. So it's the same concept as trading the one-sided market, but the only difference is though that the swing entry requires a lot more time and patience, and the swing entry is based off on the higher time frame. Now the swing entry, the difference between the one-sided market and the swing entry is, on the one-sided market, as the demand is going up, structure is going to also give you entries and opportunities. It's going to go like that, and then after every single pullback you're going to catch it. But on the swing entry, there's only 1 to 2 possibilities. Either price is going to enter this order block, or it's going to enter an order block that's really near it, maybe above it or below it. So we could see that there's an order block right over here, and price actually comes all the way back down into it. Now, when we enter that area of demand or supply, in this case demand, you can choose whether you want to wait for confirmation or set a limit. Now, let's assume you set a limit. Now, the same thing again. All you're going to do is wait for price action to take out the next high. In this case, this would be the next high. And then do the same thing. Find the impulsive move that took out that high, and then find the institutional candle that resides within it, and then set a limit or wait for confirmation. And this is called the swing entry. And notice that these swing entries, they only come maybe once or twice within a year's range of time. So, and a perfect example would be, let me look for so perfect example would be right over here. So we could see that this low was taken out. This was actually a liquidity grab. Although this was a break of structure, it was a liquidity grab as well. And I have a whole concept on how you can avoid getting mistaken with liquidity grabs and breaks of structures, but we'll get into that in a different video. So we could see that this high, after this high was taken out right here, the market reverses, because we know that when the market takes out a new high, things are way too expensive to continue going up, as I said in the beginning of the video. So what the market does is it goes down so it can buy. And then when things are too cheap, when things are really cheap and they can buy, they buy. And when things are way too expensive to buy, they bring the price down, and they continue to do that. So right over here, after we took this high out, the market couldn't continue to buy, obviously, right? Because it was too expensive. So that's where selling came in. Selling pressure comes in. The market breaks past this low to liquidate it. So this was a actually liquidity grab of all the sell stops that rested below. And then the market reversed once again, giving us another continuation of structure. Now, after this continuation of structure, what do you usually do? What you want to do is find the impulsive move that caused this continuation of structure and locate the institutional candle that resides within this impulsive move. In this case, the impulsive move was right here, and the institutional candle that resided in the impulsive move was right over here. The reason I chose this one is because, one, it was unmitigated. Two, there was a ton of imbalance that resided everywhere within this impulsive move. And three, any IC that resided below was already touched and mitigated, and I do not like things that were touched. I like things that are unmitigated. So price action enters this point of interest. And now you could obviously do two things. You could set a limit and go up, or what you could do is you could stay on the higher time frame and trade based off of supply and demand on the higher time frame. So we could see price action enters, right? So we enter this level, we set our stop loss just at the high, and then take profit at the next, or sorry, stop loss at the low and take profit at the next high, and then we just monitor structure. Now we could see that within this impulsive move, or within this pullback, we had this 1, 2, 3, 4. We had basically had this mini micro trend that was being followed. Right after that micro trend was broken, or not right after, sorry. When that micro trend was broken, we had this supply zone, which the market ended up breaking past. Price action is going to do the same thing. It's going to locate that impulsive move that broke past that supply zone, and then you find the institutional candle that resides inside of that impulsive move, and then you set your limit or you wait for confirmation. It's all up to you. So these are the two types of setups that I love to trade. Now you could set a take profit right here, but this is the thing. This is where your rules come in. On the higher time frame, this would have been a terrible trade to take because it's a 2-to-1. But if you wait for confirmation, as if you go to the 1 hour and you wait for confirmation, in this case there was actually a lot of confirmation. So we could see that there's a micro trend that's being followed as price enters our point of interest, and right over here the market reverses. So right over here the market reverses. You could even refine your higher time frame POI to this point, which explains why the market reversed here and not at these previous levels. And from that reversal, you could see the impulsive move. Find the impulsive move and then locate the institutional candle that resides within the impulsive move. That's what we have right over here. Now you could take it a step further. You could take it a step further by waiting for more confirmation inside of this zone or even over here. But if you're more like me, one mitigation is enough, or two mitigations is enough for you. 1, 2. So entry would have been right over there, and then take profit would be the next high right over here for a 7-to-1, 7-to-1 and a 8-to-1, or 6-to-1, sorry. So 7-to-1 and a 6-to-1. So that's basically the two types of setups. And the first setup, as I said, it'll be found mainly on the 1 hour, 2 hour, 3 hour. And they're basically mainly found when the market is trading against, when it's in its pullback phase. So if we're in a uptrend and the market is in its pullback phase, this is where the one-sided market is going to come in clutch. But if we're on the higher time frame, such as the 4 hour, the daily, the 12 hour, the swing entry, that's going to come to you after every time we break above a macro swing point high, and the market will come all the way back down, or maybe to the 50%, give you an entry, and then go all the way back up. And then as you guys can see, we had one swing entry here, and we had a second swing entry here. And obviously no one really, I mean, if you did hold it for whatever reason, shout out to you, you're like a witch or something, or a wizard, because I would have no anticipation that USDJPY would be coming this high unless it was from fundamentals. But as you can see, you could have swung this for a 44-to-1 to a 81-to-1, which doesn't really make sense. I won't lie. Me personally, I would have never done that. But, you know, who am I to say what's possible, not possible? So, yeah, thank you guys so much for watching. Actually, let me go over one more example and we'll call it a day. So one more example is we take out this high, and then you find the impulsive move that was the cause of this break of structure, or a continuation of structure. Right here we have that, and all you want to do now is take your fib out, measure the open to the close of the expansion, and then look for institutional candles within the blue zone. Now the blue zone would be better. Anything above you can still take it, but wait for extra confirmation. So in this case we have an unmitigated candle right over here. Right, price action comes all the way back down into this IC, and then from here we reverse. And remember, as I said before, this requires a lot of patience. And after price action enters your point of interest, right, and it goes up, what you also want to do to catch a second entry, which would be probably done on the 1 hour to 2 hour, is you want to watch the micro structure that took place into the hour point of interest. So you have a micro low, a micro high, a micro low, another micro low, a micro high and another micro low, a micro high and another micro low, and then you have this impulsive move right over here. This impulsive move right here is the break of structure of all this bearish structure right here. From here, same concept. Find the impulsive move up, locate the institutional candle that resides within the impulsive move, and then set your limit. And you would have caught two entries. One right here off of the higher time frame if you didn't wait for confirmation, and then one and that would have been a clean 5-to-1, which is pretty good. And then a second one, which would, it looks like would have been 8-to-1 to 10-to-1. Let me just double check. But another entry right here, which would have been a 6-to-1. My bad, not a 5, not a 8-to-1, but a 6-to-1. So yeah, thank you guys so much for watching this video. I hope you guys found this video helpful. If you found this helpful and informative, then please leave a like, comment, and subscribe. And if you're interested in trading beside me and learning exactly how I trade, then click the link in the description. I have a course and a Discord community in which we go over trades together, in which I teach how I trade and where I send signals. So once again, thank you guys so much for watching. I hope you guys found this helpful, and I'll see you on the next one. Peace out.